Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Park Hotels and Resorts Inc. quarterly report. Park is a leading lodging REIT that offers a diverse range of services through its extensive portfolio of iconic hotels and resorts. The company provides accommodations at 39 premium branded properties, totaling around 25,000 rooms across prime city centers and resort locations. Park Hotels and Resorts Inc. Stock price drop. A year of challenges in the past year. Park Hotels and Resorts Inc. (PK) has experienced a significant decline in its stock price, dropping by approximately 48.92% from its 52-week high of $16.23 to its 52-week low of $8.27. Several key events have likely contributed to this substantial decline. The company's fourth quarter and full year 2024 results, which included a transformative renovation announcement for the Royal Palm South Beach, Miami, may have influenced investor sentiment negatively. The subsequent first quarter 2025 results, although reported after the stock had already hit its low point, could have confirmed existing concerns and further impacted the stock. The sale of Hyatt-centric Fisherman's Wharf in San Francisco for $80 million was also a significant event, which may have been interpreted by the market as a sign of underlying challenges or a difficult transaction environment. Additionally, analyst downgrades, such as Citigroup's downgrade to neutral, due to a tepid RevPAR environment and potential for continued pullback in consumer travel, likely began to manifest earlier in the year. The combination of these factors has exerted downward pressure on Park Hotels and Resorts Inc.'s stock price, reflecting broader market concerns regarding the hospitality industry and consumer travel. The primary drivers of revenue growth or decline in the hospitality industry are multifaceted and influenced by several key factors. Occupancy levels and average daily rate, ADR, play a crucial role in determining revenue growth, with high occupancy rates and ADRs contributing to increased revenue. Group demand is also an essential driver, as it can significantly impact hotel revenues. Transformative renovations at certain hotels can boost revenue through enhanced guest experiences and improved amenities. Conversely, decreases in group and transient demand, such as the 5.6% decline observed in Hawaii hotels, can lead to revenue declines. Additionally, operational disruptions like the suspension of operations at Royal Palm South Beach, Miami, for renovation can also negatively impact revenue. On a positive note, increases in food and beverage revenue, as seen in Orlando hotels, 5.5% and 6.9%, can contribute to overall revenue growth. However, fixed costs such as rent, property taxes, and insurance can eat into hotel revenues, leading to declines. Overall, the interplay of these factors determines the trajectory of revenue growth or decline in the hospitality industry. Net income and profit margins decline. A shift in hotel occupancy rates the financial performance of the company has taken a significant hit in 2025 compared to 2024. Net income plummeted from $57 million to minus $14 million, and from $153 million to minus $73 million over 3 and 9 months respectively. This drastic decline is attributed to a decrease in occupancy rates at certain hotels. Profit margins also suffered, with operating income margin decreasing by 4.9% and 8.8% over the same periods. Net income margin dropped by 11.1% and 11.5%, resulting in negative margins of minus 2.3% and minus 3.8%. The primary reason for this decline is a decrease in net cash provided by operating activities, down by 16%. The sharp decline in hotel occupancy rates has had a ripple effect on the company's financial performance, leading to reduced revenue and increased losses. This trend highlights the need for the company to reassess its strategies and adapt to changing market conditions to mitigate future losses. The company's financial performance indicates a positive trend in its operating cash flow. Despite a decline from $349 million to $293 million, the operating cash flow remains positive, as confirmed on page 32. This suggests that the company is generating sufficient cash from its operations to support its business activities and investments. The company's debt level and interest expenses have undergone significant changes. Notably, the total debt has decreased by $26 million to $3,839 million, indicating a reduction in financial obligations. Additionally, consolidated VI's debt also saw a decrease of $2 million to $184 million. However, interest expenses have shown mixed results. On one hand, overall interest expense has decreased significantly, with a drop of $3 million for the 3 months ended September 30, 2025, and $3 million for the 9 months ended September 30, 2025. On the other hand, interest expense associated with hotels increased by $1 million to $16 million in 2025 compared to 2024. Overall, while the company's debt level has decreased, its interest expenses have shown a mixed trend, with some areas experiencing a decrease and others an increase. The company's financial performance has been mixed across various segments. Notably, the hotel segment has struggled, with a decline in adjusted EBITDA of 16.1% in Q3 2025 and 9.7% for the year to date. Additionally, management fees have decreased by 10% year-over-year. In contrast, food and beverage expenses have remained flat compared to last year. Management is optimistic about the company's future prospects. They expect to sell hotels in San Francisco by November 2025 and use proceeds from a new $800 million loan facility to repay debt. The company plans to prioritize capital allocation, repurchase stock, and deliver superior returns through active asset management and strategic growth. Management believes their scale and expertise will enable successful acquisitions and expects dispositions to positively impact financial results. They aim to maintain liquidity through a balance of cash, debt, and equity, but may issue additional securities if needed due to REIT requirements. The company has made significant acquisitions and divestitures in recent years. On the acquisition front, it has pursued both single-asset and portfolio deals, with details available on page 20. Meanwhile, on the divestiture side, the company is anticipating several dispositions without providing specific details, page 20. Additionally, it has already completed property dispositions through September 30, 2025, as well as disposing of Hilton San Francisco hotels after they were placed into receivership in October 2023. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. The financial summary reveals that the company has paid dividends in various sections of the report, indicating a commitment to returning value to its investors. Additionally, the company has also engaged in share buybacks, further demonstrating its efforts to enhance shareholder value. That concludes the financial summary for Park HOTELS and RESORTS Inc. Feel free to comment below, and I will be happy to answer them when possible.